Okay, let's unpack this. The world is just overflowing with information, right?
Yeah.
It feels impossible sometimes to cut through all that noise and actually get a clear understanding of something new, quickly.
Uh-huh.
That's really the whole point of this deep dive.
Exactly. We're taking your source material, this deep dive, specifically into specialized investment funds, or SIFs, in Nepal. And our mission is really to pull out the most important nuggets.
Kind of like a shortcut.
Yeah, exactly. A shortcut to being genuinely well-informed on this specific topic.
So you'll walk away with a clear understanding, hopefully, of what a SIF is, how it actually works, on the ground in Nepal, the key rules that govern it,
Right.
and where it really fits into the bigger investment picture there. The goal is to get past just the definitions and show you why these things matter.
Okay, so let's jump right in then. What is a specialized investment fund?
Oh.
Fundamentally, based on the material you provided, it's a regulated investment vehicle.
Regulated? Okay.
Yeah, and it's designed to pool capital, to bring money together from different investors.
Right, but it's not just pooling for anything, is it? The purpose seems quite specific.
That's right. It's targeted for investing in specific sectors or asset classes. The source material mentions some really interesting areas like startups,
Oh.
growth stage companies, infrastructure projects, even sustainable ventures.
That targeted approach seems key. And they operate under, is it SIBN?
Yes, SEBN, the Securities Board of Nepal. That regulatory oversight is, well, it's fundamental to how they're structured and how they function.
And structurally, one thing that jumped out is they're often closed-ended funds. What does that actually mean for an investor?
Being closed-ended basically means that capital is raised up front, right?
Right.
Then it gets invested over a fixed period, maybe 5, 10, 15 years, and then returned to investors as the fund sells off its assets, as it exits.
So you're locked in for a while.
Pretty much. And that structure, especially with the kinds of investments they make, often, less liquid, early stage stuff, it naturally leads to a higher risk profile compared to, say, stocks you buy on the public market.
Right. Makes sense.
But of course, the flip side is the potential for significantly higher returns if the investments do well.
Higher risk, higher potential return. This is the classic story. You mentioned sustainable ventures. The source seems to really emphasize this impact investing idea. What's that about in this context?
Yeah, that's fascinating. It shows these aren't just about the money, necessarily. The material highlights that SIFs can have this dual focus.
Yeah.
Yes, strong financial gains, but also deliberately aiming for positive social or environmental outcomes.
Okay.
So for investors, maybe like you, who care about more than just the bottom line, SIFs offer a regulated way to back ventures aligned with those values. Could be clean energy, ed tech, healthcare access, that sort of thing.
That really connects the finance side to real-world impact. I like that. So how does this all work? Who are the main players making this happen?
Well, the central figure, according to the material, is the fund manager.
Okay.
They're typically a body corporate, basically a company that's specifically licensed and tasked with managing the fund's investments, really from start to finish.
And it sounds like they have a lot on their plate. The source lists quite a few responsibilities.
Oh, it does. And it really highlights why they're so pivotal. They're responsible for finding and checking out investment opportunities.
Deal sourcing, yeah.
Exactly, deal sourcing.
Yeah.
Then actively supporting the companies once they've invested, always acting in the best interest of the investors, the unit holders.
Right.
Doing thorough due diligence, managing risk, making sure they follow all the SEBN rules, raising the actual capital from investors, managing those relationships, and, crucially, figuring out the exit strategy, how and when to sell the investments to actually make money back for everyone.
That's a huge job.
Yeah.
Requires a mix of skills.
Definitely. Finance, operations, compliance, networking.
Yeah.
It's demanding.
So within this structure, we hear these terms a lot, GPs and LPs. Can you quickly break down who's who?
Sure. Looking at how these funds typically work globally, and like it's described in the source, you have two main partner types, the limited partners or LPs.
Okay.
Those are the investors. They put up most of the capital, but they're passive.
Passive meaning?
Meaning they provide the money, but they're not involved in the day-to-day decisions like where to invest or how to manage the companies. They are the unit holders we mentioned.
Got it. So LPs are the fuel. Who's driving the car?
That would be the general partners or GPs. These are the entities that actually manage and operate the fund.
Ah, so the fund manager we were just talking about.
Exactly. The fund manager, or sometimes the initial promoters who set up the fund, usually fills that GP role in the context of these Nepalese Fs. They make the key investment decisions, oversee everything.
And is it only the LPs putting money in? or do the GPs chip in too?
That's a really key point for alignment. The source confirms that, yeah, GPs typically invest some of their own money alongside the LPs.
Skin in the game.
Precisely. Skin in the game. It helps ensure everyone's interests are aligned, They succeed or fail together. So GPs manage actively, LPs stay passive, but they get updates and hopefully their share of the profits after fees, of course.
Ah, yes, fees and profits.
Yeah.
That brings us to how the fund manager actually gets paid. The source uses some specific terms: hurdle rate, carried interest, catch-up. Let's try and demystify those.
Yeah, these are absolutely fundamental to the economics. So the hurdle rate, think of it like a minimum target return.
Okay.
It's the return threshold that the LPs, the investors, have to get on their money before the GP, the manager, gets any performance-based fee.
So investors get paid first, up to a certain point. What happens after that hurdle is cleared?
Right. That's where carried interest comes in. Once the fund's performance goes above that hurdle rate, the GP receives a percentage of those extra profits.
That's their performance fee then.
Exactly. That's the performance fee they carry. It's their reward for beating the minimum target.
Okay, makes sense. But what about catch-up? That sounds a bit different.
It is, slightly. The catch-up phase kicks in right after the hurdle is met. During this phase, the GP gets a much bigger slice of the profits, often like 100%.
100%.
For a short period, yes. Until their total share of the profits above the hurdle catches up to what their agreed carried interest percentage should be on all profits above the hurdle.
Okay. So it's like a quick boost for the GP to get them to their target share.
You got it. It just gets the profit split back to the agreed ratio, like maybe 80-20, 80% LPs, 20% GP, more quickly once that initial hurdle is passed. It ensures the GP gets their full intended share on all the upside eventually.
Okay, that clarifies it. It's all about how those profits get divided up and incentivizing the manager. The source material also mentions a few other terms we'd likely bump into. Maybe we can quickly define a few. Build up the vocabulary.
Good idea. Yeah, the material mentions fund sponsor or sometimes anchor investor. That's usually the first group or entity backing the fund, committing capital early to get it off the ground and attract others.
Like the first believer.
Kind of, yeah. Then there's the term sheet. That's a non-binding agreement, basically outlining the main points of a potential investment deal before you get into the heavy legal contracts.
Like a blueprint.
Sort of. Deal sourcing, we touched on this. It's the active process of finding potential companies to invest in.
Right.
Due diligence, this is crucial. It's the deep dive investigation into a target company before investing, checking financials, legal stuff, operations, the market, everything. Risk management 101.
Very important.
Dry powder, that's just the term for the money the fund has raised but hasn't invested yet, sitting there ready to go.
Ready to deploy.
Exactly. And finally, buyout. This usually means buying a controlling stake in a company, maybe taking it private or significantly changing who owns it.
Okay, those definitely help paint the picture.
Yeah.
Now let's zoom back in on Nepal specifics, the regulations. What does it actually take to become a licensed fund manager for a SIF there, according to the source?
Right. The requirements are pretty clear, designed to ensure only qualified players get in. First, like we said, it must be a registered company, a body corporate, and its main documents, the memorandum and articles of association.
The company's rule book.
Yeah, basically. They have to explicitly state that fund management is one of its approved activities.
So it has to be baked in from the start.
Correct. Then there's a financial hurdle, a minimum paid-up capital of at least 2 crore rupees.
2 crore. That's significant.
It shows some financial stability and commitment. And then, importantly, strict integrity requirements. Key people, like board members or the CEO, can't have criminal convictions, especially related to moral turpitude, or be blacklisted by the Credit Information Center, the CIC.
Makes sense. You need trustworthy people handling this money. And Sabin has to approve all this.
Absolutely. Mandatory Sabin approval is the gatekeeper. You can't set up or run a SIF without it. The process involves submitting a lot of documentation, which the source notes is key for transparency.
Okay, that covers becoming a manager. What about the SIF itself, the fund? Are there specific rules for how it has to operate?
Oh, yes. Quite a few specific rules shape things. For example, once Sabin gives the nod, the manager has to start issuing units to investors within 3 months.
Pretty quick.
And finish raising the capital within 2 years. There's also a minimum fund size. They have to aim for at least 15 crore rupees.
15 crore. Okay. And we talked about the manager putting skin in the game.
Yes, the manager has to keep at least a 2% stake in the fund's shares continuously, reinforces that alignment.
Right.
And here's a potentially big one for understanding who these funds are for. There's an investor limit, a cap.
A cap. How many?
Only 200 unit holders maximum.
200. Wow. Okay, so these aren't for the general public like a mutual fund then.
Yeah.
It's a much more exclusive group.
Exactly. It implies a focus on institutional investors or high net worth individuals. And consistent with that, fundraising is done via a circular or direct personal contact. Yeah, targeted investors, not a wide public offering. And the structure, again, confirmed, is closed-ended.
What about reporting? Keeping investors informed.
Crucial. The rules demand separate, audited financial statements for both the fund manager's company and the SIF itself. Plus, annual summaries have to be sent electronically to the unit holders. Keeps information flowing.
Any other notable rules?
Well, the source mentions the typical fund life, usually 5 to 15 years. There's a 1-year lock-in for investors' capital, so no early withdrawals easily. Managers collect fees periodically, and they have to deposit 10% of the service fee with SEB, kind of like a security deposit.
Interesting.
And even though it's targeted investors, a detailed prospectus is still required for selling units, ensuring full disclosure. All these rules together really define how SEFs operate day-to-day in Nepal.
And running this kind of operation, meeting all these rules, it obviously costs money. The source breaks down some specific fees.
Yeah, understanding the costs is part of the picture. For the fund manager license itself, there's a one-time registration fee, NPR 300,000, and then an annual fee of NPR 150,000.
Okay. And for the SEF, the fund itself?
The fund pays an application fee of NPR 50,000. The bigger one is the fund registration fee, and that's tiered based on the fund size.
Tiered? How so?
For funds between 1 and 50 crore rupees, the fee is NPR 500,000. If it's bigger, 50 to 100 crore, it's NPR 700,000. And for the largest funds, over 100 crore, it's 1 million rupees, NPR 1,000.
Got it. Bigger fund, bigger fee. Makes sense. Okay, so we have the structure, the players, the rules, the costs. Where do SEFs actually fit in Nepal's broader investment world, specifically private equity and venture capital, PVC?
Right. The material gives some great context here. It shows there have been, I think, 88 disclosed PEVC investments overall so far.
88 total.
Yeah, and many of those happened quite recently, mostly in the last fiscal year, 2023-24. And what's really notable is that most of this activity, the majority, is driven by local capital.
Local money. And the source breaks down where it's coming from.
Yes, it's quite revealing. Out of those 88 deals, 35 came from other local funds, 12 specifically from these SIF-licensed funds we're talking about.
Okay, so SEFs are a distinct piece.
Definitely. Then you had 16 from onshore foreign direct investment FDI and 25 from offshore FDI. So SIFs are clearly a significant and growing channel within that local PEVC activity.
A key part of the puzzle then. What kinds of businesses or sectors are attracting all this PEVC money, including from SIFs?
The source points to a few key areas. Financial services is big, healthcare, education technology, edtech, and e-commerce. These seem to track with, digitalization trends and growing consumer markets in Nepal.
That makes sense. Anything else emerging?
Interestingly, yeah. There's growing interest noted in agritech that could signal a focus on modernizing agriculture, maybe sustainability or rural development.
Are there sectors getting less attention?
It seems so. More traditional, capital-heavy areas like manufacturing or big infrastructure projects show fewer deals, according to the source, which, as the material suggests, might actually be untapped opportunities for investors with perhaps a longer view or a different risk appetite. It gives you a good snapshot of where the investment focus is right now.
The source also mentions the Nepal Private Equity Associations, NPA. What role do they play?
Right, the NPEA. They function as the industry body. The source mentions they have regular members. Those are the licensed fund managers, like the SEF managers.
Okay.
And then associate members. Those are the other players in the ecosystem. The advisors, law firms, consultants, maybe even institutional supporters who help make these investments happen. They build the community, advocate for the industry.
Got it. Okay, let's try and tie this together. How does an investment actually happen? Once a SIF is up, running, where's the cash? What's the process?
The source lays out about 6 steps.
Yeah, a typical life cycle. This is what the fund manager actually does. It starts with deal origination.
Finding deals.
Right. Actively looking for promising companies or projects that fit the fund's specific strategy. It's not passive. It's proactive networking, research, scouting. Okay, step 1. They find something interesting. Then what?
Step 2 is preliminary analysis. The team does an initial check. Is it worth digging deeper? They usually prepare an internal note outlining why or why not.
Makes sense. Filter things out early, then it goes up the chain.
Pretty much. Step 3 is investment committee, IC, approval and due diligence. If the IC, the senior decision makers, like the initial look, they approve moving forward with serious, often external due diligence.
That's the deep dive into the company itself.
Exactly. Bringing in experts to really scrutinize the target financials, legal, operations, market management team, everything.
That sounds intense, assuming it passes that scrutiny.
Then you get to step 4, final approval and documentation. If due diligence confirms the potential and the IC gives the final okay, then the lawyers get busy drafting and signing all the complex legal agreements to meet the investment official.
Money flows. Investment made.
But the job's not over, right?
Not at all. Step 5 is investment monitoring. Once the money's in, the fund manager stays actively involved. This often means taking a board seat at the company.
Right. Getting regular performance reports, tracking progress, helping solve problems, providing strategic guidance. It's hands-on.
And the final step, the payoff.
Step 6, exit strategy execution. This is critical. It's planning and then actually carrying out the sale of the investment. This is how the fund gets the capital back to return to its LPs, hopefully with a nice profit.
And the source mentioned the common ways they plan to exit.
Yes, the typical routes listed are initial public offerings, IPOs, where the company lists on a stock exchange, strategic sales, selling the company to a bigger player in the same industry, or secondary buyouts, selling the stake to another private equity firm. Choosing the right exit depends on the company, the market. The goal is always maximizing that return for the investors, the LPs.
So that's the whole journey, finding it, funding it, growing it, selling it. It sounds complex, and I bet there are real challenges for fund managers trying to do this with SIFs in Nepal. What does this source say are the main hurdles?
Yeah, the material is pretty upfront about the difficulties. One big one is just navigating the regulatory landscape. It's not only SIBIN.
Who else?
Depending on where they invest, managers might have to deal with the central bank, Nepal Rashtra Bank, NRB, or the insurance regulator, Bima Samiti, or the Department of Industry, DOI. Juggling rules from multiple bodies adds complexity.
Sounds like a lot of red tape, potentially. What else?
Finding enough good, genuinely investment-ready companies. That's a major challenge mentioned. A lot of businesses might need significant work on governance, financial reporting, or just scalability before they're suitable for institutional money, like a SIF.
So the pipeline isn't always full.
Seems to be a challenge. Taxation issues are also flagged as an ongoing complexity, which isn't uncommon in developing markets.
And actually making those exits happen, is that tough in practice?
Yes, planning and executing successful exits is highlighted as particularly challenging in the Nepalese context. Finding buyers at the right price or navigating an IPO, it takes skill and the right market conditions. And finally, just the basic task of raising public awareness, making sure potential investors in the wider market understand what SIFs are, how they work, building that trust and clear communication. That's an ongoing effort too.
Oh, those definitely sound like real-world roadblocks. So quite a journey we've taken today into SIFs in Nepal. We started with the basics, what they are, their purpose, then looked at the players, the GPs and LPs.
Right, and how they get paid the hurdle rate, carried interest, catch-up.
Exactly. Defined key terms, dug into the specific regulations for managers and funds, minimum capital, the 200 investor cap, fees.
Place them in the PEVC context, looked at sectors.
Walked through the whole investment process step by step.
From finding the deal to exiting it.
And finished by looking at those significant challenges managers face.
And pulling all these specifics directly from your source material, it gives you a much deeper, richer understanding than just skimming the surface.
Yeah.
You've really navigated a complex topic pretty efficiently here.
And thinking about those challenges, finding good companies, executing exits, the regulatory maze, plus that very specific cap of 200 investors. It makes you wonder, here's something to maybe mull over. Given that specific regulatory setup, the current investment landscape and those exit hurdles in Nepal, do you think SIF-offs are mainly going to be a tool for a pretty limited group of sophisticated investors? Or are they actually laying groundwork that could eventually open up or benefit the broader market and public down the line?
That's a really interesting question. Thinking about that balance between their current, maybe more exclusive structure and their potential long-term impact on how capital markets and entrepreneurship evolve in Nepal, definitely something to keep exploring.